An invisible financial chokehold is tightening around the throat of American homeowners right now. This systemic automated trap is quietly originating from your primary mortgage lending institution. For decades, paying your monthly mortgage note on time guaranteed long-term residential stability. You assumed your land asset was safe if you maintained the physical property structure. But the operational layout of lending changed completely in 2026. Global banking syndicates have deployed high-speed digital links to scan your homeowner file daily. Your private residence is no longer treated as a secure sanctuary for family retirement. It operates as a leveraged data position for an institution seeking to insulate its wealth. And this is where things get ugly. Imagine opening your mailbox on a standard Thursday afternoon after a long work shift. You find a cold certified notification from your mortgage servicing company. The letter states your standard private property hazard contract is no longer active. You call your retail independent agent in a panic trying to resolve the gap. But you quickly realize your neighborhood has been completely blacklisted by private providers. Whether you live near the dry canyons or along vulnerable tropical coastlines, markets are paralyzing. The financial institution gives you a strict window of 30 days to produce coverage. If your file stays empty, the bank triggers a process called force-placed insurance. Mainstream housing channels love to frame these measures as vital consumer protections for lending stability. But the ground reality is a terrifying automated ultimatum for ordinary working-class families. Would you keep funding a property where lenders hold power to alter your debt? Affluent cash buyers stand completely outside this cycle because they hold absolute title to land. But traditional suburban infrastructure faces an immediate countdown towards systematic asset liquidation. Look closely at the actual mechanics driving the housing industry across Florida and California. These two massive powerhouse regions have officially become ground zero for the lending freeze. Major private insurance carriers have quietly reduced their capital exposure across both territories. The corporate math of underwriting traditional disaster risk is permanently broken for private syndicates. When these brands pull out, the underlying bank loan immediately loses its safety buffer. Lending compliance programs automatically flag the property as an unsecured default risk. To protect their balance sheets, institutions inject their own internal commercial insurance policies. The bank charges this new premium amount directly onto your monthly escrow statement. Local politicians distribute statements claiming state backup pools will stabilize the regional market values. But the real-world consequence for fixed-income households is a brutal double-state financial blockade. There is zero human path to appeal the automated decision of the lending machine. This rigid reliance on credit risk software shifts the entire macro burden onto you. The true devastation of this system lies within the pricing mechanics of forced contract. These bank-mandated policies do not follow traditional retail market pricing structures. A standard policy that used to cost $3,000 jumps to $14,000. That represents an immediate 4 to 100% spike added directly to your fixed household expenses. Worse yet, these expensive institutional policies provide zero personal liability protection for your family. If a guest gets injured on your grass, the bank policy pays absolutely nothing. The expensive contract is specifically designed to protect the lender's remaining mortgage balance only. If your monthly retirement check fails to cover this inflated fee, the foreclosure engine activates. Real estate influencers spent years marketing long-term homeownership as a reliable generator of generational wealth. But under this current system, that mortgage contract operates as a legal trap. What options do you hold when an algorithm doubles your monthly overhead without permission? The middle class is being crushed between escalating premium numbers and rigid bank compliance. Take a deep breath, because panicking will never save your hard-earned property equity. Understanding the exact legal framework of your mortgage note will give your power back. The landscape is changing fast, but you do not have to be the victim. If you carry an active loan balance, do not let your coverage lapse for 24 hours. Proactively apply for state-backed backup programs before your private retail carrier drops your file. Avoiding the brutal force-placed insurance penalty from your bank is your absolute #1 priority. Second, beat the automated software models at their own game with immediate structural mitigation. Clear the dry brush, trim tree branches back, and upgrade your roofing materials. Document every single property hardening project with clear video evidence to challenge the scans. Third, if your coastal property is fully paid off, look at the mathematics closely. Stop funding an overpriced contract that carries an insane $100,000 deductible. Many smart owners are choosing to build their own high-yield liquid emergency reserves instead. You are not completely helpless against this corporate algorithmic financial squeeze. The American dream is not dead. It just requires a smarter mitigation strategy. By taking proactive action today, you can defend your family assets from systemic loss. Are you currently facing forced insurance penalties or non-renewals in your area? Share your specific zip code and your current premium numbers down below right now. Let us map out this lending landscape together as an independent consumer community to fight back. Stay grounded, execute the practical mitigation steps, and subscribe to stay fully informed. I will see you in the next report.